This is Retirement Lifestyle Advocates Radio. I'm your host, Dennis Tubbergen. Glad you decided to tune in today. Hey, joining me in segments 2 and 3 of today's program is returning guest, Mr. Michael Oliver. Michael is the founder of Momentum Structural Analysis. Michael has a very unique way of analyzing markets, and he's got a terrific track record. So I'm going to get Michael's take on what happens moving ahead, what happens to stocks, what happens to commercial real estate, what happens to gold, U.S. Treasuries. You're going to want to make sure to stay tuned for that. Also, here in the month of July, I do have a brand new special report for you. It is titled Tax-Free Retirement Income Strategies. If you would like to get a copy of that report absolutely free, all you need to do is visit the website, requestyourreport.com. Again, the website, requestyourreport.com. And when you visit the website, all you'll need to do is let me know where you want me to mail that report, and I will rush it out to you at no cost and with no future obligations. So again, the website, requestyourreport.com. I was reading an article this past week about how the swimming pool industry is doing in the current economy. Now, after I read this piece, it occurred to me that a swimming pool indicator might indeed be a reliable leading economic indicator. Can it forecast things to come? Let me tell you what I mean. According to the article, which was published on Axios, it seems that the swimming pool boom that we experienced during the pandemic is now over. Initial estimates are that 60,000 residential pools will be constructed this year, which would be exactly half as many as were constructed in 2021. Now, there is a company by the name of Pool Corp, and Pool Corp distributes pool equipment, and they estimated that pool construction would be down 20% from last year. And if current trends continue, according to Pool Corp, and the swimming pool market continues to weaken further, which is the current trajectory, there could actually be fewer swimming pools built than were constructed during the Great Recession year of 2009. And of course, as we all know, that was immediately following a housing bust. Now, as you dig into the swimming pool statistics, it's interesting how you can find evidence of the wealth gap existing in the swimming pool market like you can in so many other areas of the economy. The Axios piece I referenced reported that higher end pools with the fancy waterfalls, with the decorative tiling, the higher end pools are selling just fine. It's the demand for the lower end swimming pools that is slowing. Now, when you stop and think about it and consider this, it really does all make sense. First, higher-end swimming pool purchasers tend to pay cash for their purchase. Lower-end pools are more likely to be financed. And when you think about the fact that interest rates have risen significantly over the past 2.5 years, that makes the payment for financing a new swimming pool much higher than it was just a couple years ago. And of course, the obvious item, the elephant in the room, if you will, is that inflation has consumed a lot more of the discretionary purchasing power of American households. You only need to look at the fact that during the pandemic, there were 3 rounds of government stimulus. And as this stimulus was distributed to much of the American public, consumer savings rose to more than $2 trillion, according to the San Francisco Fed. Then, in a period of less than 2 years, the collective savings of Americans dropped from more than $2 trillion to less than $200 billion. It took less than 2 years for Americans to collectively blow through, if you will, nearly $2 trillion in savings. And then credit card debt started to build. Credit card debt went from about $800 billion to the present level of just under $1.4 trillion. And now credit card debt accumulation has also started to fall off, indicating that perhaps we are seeing Americans now reach the limit on their credit cards. That could be really bad news if that is the case for a consumer spending dependent economy like the US economy. Now, often when people buy a new home, they say, wow, this place would be nice if it only had a swimming pool. So pools are often added when a new home is purchased. Well, home sales are down, so that's another drag on pool sales. And getting back to the inflation argument, the simple cost of constructing a swimming pool has gone up substantially. The average pool cost pre-pandemic, going back to 2020, was about $40,000. That's about what you would spend on average to put in a swimming pool. Today, that number is somewhere between $65,000 and $70,000 for the same pool. That means costs are up somewhere between 65 and 75% in just 4 years. Now, if you've been paying attention to what's going on in the fast food industry, the return of the $5 meal is upon us. The fast food industry is cutting prices, coming up with packages to try to win back customers. A lot of swimming pool companies are doing the same thing. A lot of swimming pool construction companies and pool equipment companies are now offering hefty discounts to help spur sales of swimming pools. So when you look at all this, when you look at the swimming pool indicator, to use that term, it seems that the U.S. economy is heading for, or perhaps is even already in, a recession, and inflation is still taking its toll on living standards. And along those same lines, the newspaper The Epoch Times recently ran a story on a report published by Bankrate. Bankrate reported on a survey that was conducted by YouGov. YouGov surveyed Americans and asked them whether or not they felt like they were financially secure. Now, the study concluded that Americans, on average, said they needed to make $186,000 annually to feel financially secure. That's a pretty big number. And it's more than twice the average full-time worker's wage, according to the Census Bureaus. The average full-time worker's wage, $79,209 a year. Now, that average is perhaps a bit misleading because someone making $500,000 a year certainly brings that average up. A far more useful statistic is median income. But back to the YouGov survey. 75% of those surveyed said they were not financially secure. 45% said they believed they would reach financial security one day, and 30% had essentially thrown in the financial towel saying, I'm never going to get there. It doesn't matter what I do. That's a big number, a big percentage of the population that is extremely pessimistic. Now, not surprisingly, younger survey respondents were more optimistic than older survey respondents simply because they have more time to reach their goals. 42% of baby boomers between the ages of 60 and 78 said they did not feel financially secure. 37% of Gen Xers aged 44 to 59 said they were financially secure. And 12% of millennials aged 28 to 33, and 13% of Gen Zers aged 18 to 27. Now, the younger generations were a lot more optimistic. They said, I'm not financially secure now, but they felt like they would be someday. 64% of Gen Zers, 53% of millennials, and 48% of Gen Xers said, I'm going to make it. But only 26% of baby boomers aged 60 to 78 said, I'm going to become financially secure. So inflation is still taking a toll on the economy. One of the ways to combat inflation is to cut your taxes, and that brings me to my offer for this week. If you'd like to get a copy of my special report titled Tax-Free Retirement Income Strategies, all you need to do is visit the website, requestyourreport.com. The website again is requestyourreport.com. And when you visit that website, just let me know where to mail the report. I'll be glad to do that. I'll also include some bonus information for you. I'll give you a copy of my revenue sourcing book. I'll give you a copy of the best-selling Little Black Book on Social Security Maximization. I'll also include a couple recent newsletters that give you my take as to what's going on in the economy. So you'll get that big box of information to give you a second opinion absolutely free. Just visit requestyourreport.com and I'll be glad to send it out to you. I'll be back after these words with my special guest, Mr. Michael Oliver. Welcome back to RLA Radio. I'm your host, Dennis Tubergen. Joining me once again on today's program is returning guest, Mr. Michael Oliver. Michael is the founder of MSA Structural Analysis, Momentum Structural Analysis. His website is olivermsa.com. And Michael, got great feedback last time you were on the program. I'm a big fan of your work, and welcome back. Nice to have you here.
Good to be back, Dennis. Thank you.
So, Michael, for our listeners maybe that are not familiar with your work, I find it fascinating how you were kind of ahead of the curve in adjusting for the devaluation of the U.S. dollar in your work. Can you kind of fill them in on how you got to do what you're doing today?
Well, momentum is a term that's thrown around a lot in technical analysis, and usually it just means, when something's going up big, it's got momentum, Okay. What we do is we structurally break down momentum. In other words, rather than having a little loop-de-loop type indicator like RSI or MACD, it goes up and down, that kind of thing. We plot charts just like price chartists, except we plot bar charts in relationship to, meaning oscillated against certain long-term or intermediate-term moving averages. And what you get then when you do that is it's quite often a different picture than what you see when you look at the same price chart of a given market. And usually at tops or bottoms, momentum will turn first. And you'll see structure pending, meaning you'll see like a 4 or 5 point uptrend line, or you'll see a triple bottom floor. And you might not, and probably won't even see that on a price chart. So momentum will generally inform you of something that's pending before it happens. In other words, a structure that could break, and you don't want to break it if you're long, et cetera, et cetera. And we apply that to all the major asset categories. And especially in this day and age, these huge icebergs or tectonic plates are bumping into each other. We have equities, especially the U.S. stock market bubble. You've got the bond markets, you've got foreign exchange, and you've got commodities, and especially gold and the monetary metals. So all these four categories are either inverse or in sync with each other, and therefore it's important not just to pay attention to one of them. Like if you're long gold, don't just look at gold. You've got to look at other things that could impact gold, or that affirm gold, et cetera. And that's why we look broadly. And it's a very interesting world we're in right now, I'll tell you that.
So, Michael, maybe for, again, our listeners' benefit, then we'll jump in and talk about some specifics. You have a rather long history in the financial industry. Can you give our listeners a bit of your background?
Well, I joined E.F. Hutton as a futures broker in April of 1975. Gold had been legalized in January. I started trading on the COMEX, and it happened that the head of Hutton's commodity division in New York on Battery Park at the headquarters was also chairman of the COMEX. So I apprenticed under him. And he was a normal technician, like everybody was back then. You plot your bar charts. And by the way, you plotted them by hand back then. Okay, you didn't have Excel. Okay. And anyway, so I learned the normal orthodoxies of, normal technical analysis. And but I evolved away from that over time because I realized that when you look at a price chart, you're not just looking at the price of a given asset. You're looking at its valuation compared to a piece of fiat currency. Now, if you plot something with it against the yen or plot something against the euro or against the dollar, you might get a different picture. And you've got to realize that ongoing, the central banks have always destroyed their money units in terms of the quantity available and therefore the real underlying value of the currency unit. Like in the US, for example, since the late 1950s, just about every decade, the money supply has doubled. Okay, it's meaning decayed. Okay, each dollar unit in your wallet isn't worth as much. When I was young, a loaf of bread was 20 cents or 18 cents. Okay, what is it now? Okay, is that because we got a wheat drought? No, of course not. It's because of the underlying decaying value of the money in it. So when you plot things on a price chart, you're not just plotting the price of wheat or the price of gold or stock market. You're plotting it also versus a variable, not a normal yardstick that 36 inches is always 36 inches. Instead, it's the dollar. And the dollar isn't of the same value one decade to another, or even 1 year to another. And so we thought we could step away from that at least partly by measuring the momentum of the dynamics of that given market. Yes, we're stuck with measuring it versus the dollar, but we measure it versus its own moving averages, which are either dynamic or dull, depending on the market itself. So to some extent, we take a half a step away from simple price chart analysis. And it gives us that slightly different picture. And we argue and have, I think, demonstrated over 32 years of our reports that quite often momentum will lead price and show you things that price doesn't show you.
Well, I'm chatting today with Mr. Michael Oliver. He is the founder of Momentum Structural Analysis. His website is olivermsa.com. So, Michael, before we get into some of the specific markets that you analyze, what's your take on Fed policy moving ahead? Rate cuts this year? How many? How do you see things playing out?
Well, first off, you've got to realize if you're long stocks and applauding for or hopeful that they'll cut rates because you think that'll help the stock market, do your history, do your homework. Okay, back in 2000 top, the market was topping at the dot-com top. In January, first day of trading in January 2001, not far off the high, the Fed cut rates. The market started to collapse. They cut rates all the way down to 2002. Okay, it didn't help a bit. Okay. 2007, the stock market was trying to top out. Many of the key sectors like housing and banks were already weak. But the S&P was in September of 2007, was punching up toward its highs. Fed cut rates in September 2007. And the market peaked 4 weeks later, and that was the top. And you collapsed all the way down through 2009. Fed rate cuts all the way. So don't cheer rate cuts. Okay. What do we think about now? I think the Fed is scrambling and hoping for some data points that they can latch onto. Particularly, they have the two mandates. One is the quote inflation as they falsely and narrowly define it. They don't mind inflated stock prices, but they do mind inflated corn prices. Okay. So
That's a great
they've got that mandate. But on the other hand, they have unemployment. And that is correlated well to the stock market. Because when the stock market starts to head down from a major top, the data points follow it. Okay. Now, their data points of the last 6 months or so have looked, quote, good. And there's many economists scratching their heads saying, why does he say things look good? Because they're really not. Those data points show, part-time jobs overtaking full-time. They show it in sectors like government, hospitality, home care, not in the key industrial areas. So I think the Fed wants to cut rates, and I think they're looking for a data point that they can use. And why do they want to cut it? One arena we're particularly watching is commercial real estate. We know there's a lot of debt problems there, and if that sector, if you'll look at a chart, for example, of RWR or VNQ, those are two major ETFs of the REIT, Real Estate Investment Trust market. They're laying in the bottom third of the price range of the last handful of years, not at the top end. They're not reflecting what the S&P is trying to say with its narrowly listed symbols. That's an area to watch because as it goes, banks will go. And banks look pretty anemic too. But there's another new variable that just hit the screen. And it actually hasn't just hit the screen, but it's becoming more noticeable. That's the collapse in the yen. That is a major issue because the yen, the Japanese are part of the club. Okay. Remember what happened to the Thai baht currency back in 1997 and 98. People don't remember that much, but that was caused the Fed to cut rates sharply in late 1998 when a panic hit based on the repercussions of the Thai baht collapse. It was, who cares about Thailand, right? Okay, compared to Japan. But even that had wave effects across that part of the world, ultimately hitting Russia and caused the collapse of long-term capital management, a huge hedge fund in the U.S. And that's what sparked Greenspan into a panic mode of 3 rate cuts in 1998. Right now, we have a collapsing yen, not a Thai baht. Okay, get a chart, go back to 2011, and you'll see the drop. It's been like 53 or so percent drop. A lot of that's occurred in the last 2 years, and a lot of it's occurring in recent months. So we have a currency that's out of control on the downside, and it's part of the club. It can't be allowed to collapse because it will have repercussions. The Thai baht had wave effects like it had. Imagine what the yen could have. So one of the reasons for that is that our interest rate differential between the Japanese rate and ours, we have a much higher premium, and therefore it's hurting the yen. That's the argument that most economists make, and I agree with it. And that's a factor that the Fed can act upon, namely cut our rates and therefore narrow that painful differential. That's not talked about, but I suspect that's a variable.
So, Michael, we've got just a couple minutes left in this segment. Overall, how do you see U.S. stock market indices moving ahead?
Basically, we said in 2022 in January that the market, if you're long the market from an investment grade point of view, be gone. Market dropped 25 to 30%, depending on the index. It's taken over 2 years, and it's finally come back. Now, I say it has come back. I'm talking S&P and NASDAQ in particular, and nipped out the 2022 price highs. Okay, by, double-digit percentages. Okay, fine, 10, 15%, that kind of thing. So people think, it's going up forever. This is the way tops have occurred in the U.S. stock market. They've been arduous and taken a year or so. This one's taken several years because the nature of the bull market that preceded it is much greater in dimension, percent-wise, and in duration. So it takes longer to top the beast. But if you look at some of the underlying parts of the market, like Russell 2000, or look at it this year, for example, what's the year-to-date gain? S&P, NASDAQ up in the teens year-to-date. Dow up 3-point-something%. Wow, big deal. Russell 2000 up less than 1%. This is a market that's, these two indices, particularly NASDAQ 100 and S&P, are led by about 4 or 5 stock symbols. We know the names, the ones that everybody's watching, NVIDIA, Microsoft, Apple, etc. Not by the breadth of those indices. So don't be distorted by what you think you see when you look at an S&P chart. And I think the Fed knows that. And I think once that market breaks, and I think it's going to start to show breakage during this quarter, our technicals argue that if you sneeze, even to the extent of 3 or 4% from where you are right now, you're going to start to get some breakage that people will notice. I'm not talking crash, but I'm talking something enough to smack people in the face. Again, you can't tolerate right now a 3 to 5% drop in the S&P and NASDAQ. If you do, you're going a lot further.
Well, my guest today is Mr. Michael Oliver. He is the founder of Momentum Structural Analysis. His website is olivermsa.com. And I'll continue my conversation with Mr. Michael Oliver when RLA Radio returns. Stay with us. Welcome back to RLA Radio. I'm your host, Dennis Tubbergen. Joining me on today's program is Mr. Michael Oliver. He is the founder of Momentum Structural Analysis. He is a returning guest, and we're chatting with Michael about his analysis of different markets and his take on the U.S. economy. And Michael, let's just talk a little bit here about U.S. Treasuries. If the market is topping here, often U.S. Treasuries are a safe haven asset. How do you view U.S. Treasuries moving ahead, and will they once again be a safe haven?
Well, the Treasuries, yes, that's a good point. They certainly weren't a safe haven in 2022. S&P down 20-something%, NASDAQ down 30-something%, and Treasuries down 35%. I'm talking 30-year Treasuries, long end of the market, the end that the Fed doesn't control well. Well, of late, the Treasuries have backed off again. And this is not because the Fed is keeping rates high. It's because the long end of the market, they don't control. And that's the end of the market that could choke things like commercial real estate. And so the Fed is a bit concerned, I have no doubt, about the Treasury market, the long end dated part. Also, if you look at, we mentioned the yen before. If you look at a yen chart, last couple of years particularly, and look at a T-bond price chart, not a yield chart, you'll see they're quite a bit in sync. There was the rally we had late last year in T-bonds. You also had one in the yen. It's since rolled over. Yen making new lows. Treasury's not, but they're still under pressure. And I'm sure the Fed doesn't want to see that continue because that's what's helping choke the yen, our high yields. Okay. So to some extent, it's out of control. Now, there are technicals above the T-bond market. Like T-bonds right now are trading futures. We're talking 30-year futures, so around 116 and a half. Okay. Last last quarter, they got up above 120. Okay, meaning higher price, lower yields. But they've since dropped 4 points from last month's high. If you get back up there again and close a month out during this quarter, new quarter now, July, August, September, our 3-quarter average momentum charts say you're probably turning up, meaning yields will start to drop. And I suspect in part that will be due to Fed panic because maybe perhaps heavily weighted because of what the yen is doing and the potential damage it could do. Therefore, they have to act in some way. Also, if you're an asset manager, like you said, the normal 60-40 portfolio, you have 60% stocks, 40% bonds. While it was hell in 2022, it might be ripe again to be used. And if you go back and look at the 2000 top in the stock market and look at the 2007 top in the stock market, there were two markets that advanced after each of those stock market peaks. And they advanced hand in hand, gold and T-bonds together. They both rallied contrary to the stock market that declined. So if we're correct that the stock market is making a broad top, then it's quite possible that T-bonds could become, as you said, the alternative again. They're certainly underpriced. Okay. So that could come into play. There are technicals that need to be triggered before we can pound the table on that. And you're not there right now. But frankly, if you go back up toward last quarter's price highs, again, above 120 on the T-bonds, and you close a month out up in that area, that's a breakout for us, and that suggests that yields are going to start to drop, at least on the long end, and probably due to some Fed panic.
So, Michael, you mentioned gold. Gold and T-bonds both rallied after the stock market started to decline in 2007. What's your take presently on the gold market and, to the extent you're comfortable, the silver market?
Yeah, we think both, which have been in advance, silver more irregularly, but gold more regularly, since the 2015 low. Gold was $1,050. It's now more than doubled. Okay. If you go back and look at its bull markets over the last 50 years, the bull markets have been 8 and 10-fold moves, from bear low to bull high. And often they take 10 years, 2000 low to the 2011 high with 11-year trend. Okay. So they're not something that happens in 3 years. Right now, we're entering the 9th year. Okay, so we're getting old in the gold bull market. But what happened in those prior bull markets is an acceleration phase late in the bull market, where you might have arm wrestled your way up for multiple years, but suddenly in the last year of that move, you go vertical. The market catches up to reality. And I think gold has now entered, and silver has now entered that phase where it's no longer arm wrestling. We're about to enter the acceleration phase, where suddenly it's a wet bar of soap situation. And I think silver will outperform gold during that process. And I think it's already started to do that. In fact, if you measure, for example, year to date, where June close was 2 quarters into the year versus the December close of last year, gold's up 12+%, silver's up 21.9. Okay. Yeah, silver might be irregular, but it's gaining versus gold now. It's regaining turf. So on a performance basis, our preference in the monetary metals now is silver. And I think the gold miners also are very undervalued, and they're showing technical signs of wanting to catch up as well.
So, Michael, when you're looking at mining shares relative to gold, do you see mining shares outperforming the metals themselves, or how do you see that playing out moving ahead?
Yeah, well, one, we know they're vastly undervalued. Okay, and there's some major fund managers like Stanley Druckenmiller, for example, back in mid-February. Made a headline, dumped a bunch of big name tech stocks and bought some big name golds, including Newmont, the biggest gold miner out there. And if you look at the chart then in mid-February, Newmont was trading 31, $32. It's trading 42 right now. Okay, so not a bad percent gain since mid-February. He might have been chuckled at when he did that by other asset managers, but he beat the S&P from here to okay during that time. I think that sector is vastly undervalued, and even people who are not technicians can measure that. And our technical measurements of the spread relationship between gold and the miners. We use, for example, GDX, which is a mixture of primarily gold miners, but also silver miners, versus gold. And we measure that month to month, the relationship between the two. And we're seeing evidence of upturn in the relative performance of the miners versus gold. And quite often, this is the case late in those bull trends as well. Now, I'm more positive on silver versus gold than I am the miners versus gold, but I do think miners will probably beat gold. And in part because they're vastly undervalued on all kinds of measures. And I think other asset managers realize that.
So, Michael, you had mentioned that past gold bull markets have been 8 to 10-fold moves. You think silver will outperform gold? Do you have a price target on silver, or is that an unfair
No,
question?
it's nothing would shock me, and I'm quite serious about. I mean, a couple $100 silver would not shock me. Now you say, well, that's a silly notion. Okay, well, if you could run a spread chart of silver versus gold, pick out one month in every year. What is the highest month in the year where silver relationship to gold was the highest? Okay. If you go back 50 years, you're going to find that probably about a third of those years, silver was at least 2.5% of the price of gold. Okay. Right now, silver's over 1% of the price of gold. Well, if silver went to a normal 2.5% the price of gold, even at current value, that would put silver where? With $2,300 gold, do 2.5% of that. You're off the page. Okay. Now, if gold had an accelerated phase here, like it did in the prior bull markets, where in the last year of the move, it was ballistic, relatively speaking, and you went to, let's say, $8,000, which is to replicate the dimensions of the prior bull markets on a ratio basis, silver would be a couple $100 if it's just back to its norm of 2.5% of the price of gold. So I'm not putting out a target there. I'm just saying, look at the realities of the last 50 years, the relationship between silver and gold. Where has it been? It's not uncommon for silver to be 2.5, even 3% of the price of gold. And I think it's headed in that direction now.
Interesting. I'm chatting today again with Mr. Michael Oliver. His website is olivermsa.com. I'd encourage you to check it out. Michael, I read recently that the relationship between commodities in general and stocks in general is at the lowest point in 50 years.
Yes.
Does that mean that we're going to see this big bull run in commodities in general moving ahead?
I think we will, because one of the prime factors of any asset class movement, unfortunately, is the central bank and what they do to money. And if they go into a panic mode again, because their stock market starts to break and because commercial real estate is in jeopardy and there's consequences there, they start putting out the fire with monetary excess, which is what they always do. And I'm not talking just the Fed, I'm talking ECB and BOJ, et cetera. Then that money goes somewhere. And asset managers don't always put the money, the river flow, where the Fed wants it to go, as they did in 2001 to 2002. It didn't go into stocks. 2007 to 2009, it didn't go into stocks. The money flow went into bonds and gold and commodities to some extent. Go back and look at the late 70s also. That's when we had stagflation. At that point, commodities joined gold. They were lagged to gold. They are now too. But I think the commodities are showing a birth last quarter, and I think you'll see more this quarter, where they're turning up again and starting another up leg, much like we saw from late 2020 to early 2022, where the Bloomberg Commodity Index doubled. Now, also look at the historical price level of the Bloomberg Commodity Index. It's trading what? Just above 100 right now. You go back and look at its 2008 high, it was 270 something, I think it was, or 238, excuse me. And I think it was like 170 something in 2011. So it's hardly overpriced, historically speaking. So commodities are not high priced. Yes, they're up from where they were at their depths in 2020. So the percent gain is pretty good, but they're still very cheap. And they're showing the technicals to us, both on the Bloomberg and also some of the key components, that they're wanting to turn up again, in which case this time they'll join gold. Gold's already in the upside.
Well, my guest today has been Mr. Michael Oliver. His website is olivermsa.com. I'd encourage you to check it out. I'm a big fan of Michael's work. I follow it regularly and encourage you to do the same. Michael, thank you for joining us on today's program. Love to have you back down the road and always appreciate you taking time out of your very busy schedule to join us.
Thank you, Dennis, very much.
We will return after these words. You are listening to RLA Radio. I'm Dennis Tubergen, your host. And thanks again to my special guest today, Mr. Michael Oliver, for joining us on today's program. At the close of the first segment of today's program, I talked about the fact that YouGov did a survey and it found that there is increasing pessimism among all age groups about being financially secure. 52% of baby boomers aged 60 to 78 said they do not feel financially secure. That's more than half. 37% of Gen Xers aged 44 to 59 said they weren't financially secure. Millennials aged 28 to 43, 12% said they were not financially secure. And 13% of Gen Zers aged 18 to 27 said the same thing. What's interesting is that the younger generations are a lot more optimistic about becoming financially secure. 64% of those aged 18 to 27 said, yes, I will be financially secure someday. When you go to the millennials aged 28 to 40, there were a higher percentage of those that said they were going to be financially secure someday. 53% of millennials said, yes, I would be financially secure. 48% of Gen Xers and only 26% of baby boomers said they will be financially secure someday. So inflation is continuing to take its toll. In fact, when you look at the effect this has on the housing market, when you take a look at what's happened with interest rates, and be sure to mark your calendars to listen to next week's program. My guest will be Dr. A. Gary Schilling. We're going to talk a lot about the real estate market, both the commercial real estate market and the residential real estate market. But when you look at the current real estate market, there is a report out from the real estate research firm Resi Club that revealed the most affordable housing markets in the U.S. and the most unaffordable housing markets. Now, if you look at the market of Pittsburgh, Pennsylvania, that is the most affordable housing market in the country. 25.6% of non-homeowner households could actually afford an average price home in that market. So these are households that are not homeowners. And of all those that are not homeowners, about 1 in 4 in Pittsburgh could actually buy a house if they wanted to. Detroit, Michigan, the second most affordable market, 23.1% of non-homeowners could afford to buy an average price home. St. Louis, right behind Detroit at 22.6%, Oklahoma City, 22.5%, and Cleveland, 22.4%. So the 5 most affordable housing markets in the country: Pittsburgh, Detroit, St. Louis, Oklahoma City, and Cleveland. Now, those are probably not considered to be glamorous metropolitan areas. Now, when you look at the other end of the spectrum and look at the 5 markets that have the lowest percentage of non-homeowner households who can afford the purchase of an average price home, you find that the 4 most unaffordable markets are all in California. San Diego, California, only 2.6%, or about 1 in 40 non-homeowner households could afford the purchase of an average price home. That's followed by San Jose at 2.7%, again about 1 in 40. Los Angeles at 2.8%, San Francisco at 3.7%. Salt Lake City is the 5th most unaffordable housing market in the country, where only 3.8% of non-homeowner households could afford to buy a home. So inflation continues to take its toll. Higher interest rates, or what I should say are more normal interest rates, are having an impact on the real estate market. And just when you thought that fees potentially couldn't get any higher, we now have banks saying we're going to have to do away with free checking and we're going to start charging for services that now are free. What's really happening here is that these are going to be unintended consequences of new policies put forth by politicians that we can argue are well-meaning, but perhaps short-sighted. Chase Bank just announced that the bank is ready to implement new charges for services that are now provided for free if new proposed government regulations take effect. So what are these new regulations? Well, the problem-solving elites in Washington, D.C., interventionist politicians, if you will, maybe we even want to say politicians that overregulate, often cause unintended consequences, and that's exactly what is happening here. The head of Chase Bank, a division of J.P. Morgan Chase, Marianne Lake, was quoted in the Wall Street Journal as saying the bank is preparing to charge customers for now free services, including checking accounts and wealth management tools, if new rules pushed by politicians in Washington are enacted. What are these rules? These rules would cap overdraft fees and cap late fees. The Consumer Financial Protection Bureau proposed if you're late making a credit card payment, the most you can be penalized is $8. And if you write a check that you do not have money in your account to cover, the most you can be charged for that error is $3. Seems like that is just encouraging bad behavior, if you ask me. Now, in March, the Consumer Financial Protection Bureau did pass a rule capping credit card late fees. Bank industry groups went to court. They sued to stop it before it became law. That law is now pending an appeal before a judge. So the courts will eventually decide this. So even though the courts will decide this, credit card companies are already making plans in case this becomes law. According to the Wall Street Journal, Chase has already sketched out plans to ratchet up interest rates and take a more conservative approach to underwriting credit card loans. In fact, if this does indeed become law, you will probably see someone who's carrying a credit card balance pay down their balance and then find that the bank has reduced their credit limit to whatever their current balance is. This has happened before. It will likely happen again. Dan Gorlick, a consulting partner at PricewaterhouseCoopers, advises banks. He is a consultant to banks, and he noted that mega banks will make up for a dent in consumer banking revenues with profit from their wealth management and investment banking arms. However, smaller regional banks will have difficulty doing the same. So if you're enjoying free services from your bank, enjoy them while they last. That may indeed be coming to an end, and that may indeed increase the cost of you doing what you do day to day yet again. Now, if you have not yet requested the brand new special report I have for you, it is titled Tax-Free Retirement Income Strategies. If you'd like to get a copy of that report, simply visit requestyourreport.com. I'll be glad to send you a copy of it. Again, the report is Tax-Free Retirement Income Strategies, and I'll be glad to send you a complimentary copy if you'll visit requestyourreport.com and let me know where to mail it. Also, a quick reminder, there are a lot of free resources at our website, retirementlifestyleadvocates.com. That website again, retirementlifestyleadvocates.com. That's all the time I have for this week. I'll be back again next week. Have a great week.